Good morning, guys. How are you? So, yeah, I denoted everyone as guys because we all are peers. So, in order to better understand each other, better know each other, better understand the topic, let's be peers. Let's not anyone be sir, ma'am, anything else. Let's be friends for next some time. So I'm here to discuss with you an important topic with respect to statutory audit, which is known as interested directors. But before we move ahead, what does interested director means, how we audit them, what are the compliances, what are the risks? Let's first understand what is statutory audit and where it is required. So I would like to gain certain understanding from the audiences if they can help me, like what is statutory audit? Yep. So after getting certain answers, we got to know that statutory audit is an audit of financial statements, which is required by Companies Act 2013 under certain provisions of Section 139. Okay. So who can conduct the statutory audit? Of course, a chartered accountant. But is every chartered accountant allowed whether an employee of the company can conduct? No, of course not. So an independent chartered accountant can conduct the statutory audit. And why is this required? Anyone answers? Yeah. So the primary interest or primary requirement is to maintain the fairness of financial statement and to be the financial statement usable for the stakeholders. And here comes what is stakeholders, everyone who uses the financial statement. So there are three basic requirements: fairness, compliance, and detection of errors. All these meant up for whom? Stakeholders. Okay. Okay, so let's go ahead. Now, what do you mean by interested directors? Okay, of course, there are multiple type of directors in the companies. Some are interested, some are not interested, some are dormant directors, some are managing director, etc. So interested directors are defined in Section 184 of the Companies Act. The interested directors are the directors who are having direct or indirect interest in the company, or they are having some related party transactions, or they hold a position in dealing with the other entities of the companies. Okay. Okay, so what should we consider while auditing the statutory audit? So these are such certain guidelines. It is not an exhaustive list of audit. Audit is never ending. So this is certain guidelines which we can consider. What if there is any transaction, whether it is disclosed as an interest in the board meeting on that transaction, the transaction is discussed and approved in the board meeting. Whether the transaction is at arm's length or not. Section 188, everyone's favorite. What is an arm's length price? And that's a matter of concern. There are different theories which define the arm's length price for different type of transactions. So yeah, we should comply with section 188. If it is discussed in the meeting, then it should be properly documented in the minutes, and then transaction as should be as a part of section 188 approvals. Okay, so we have different types of risk in the audit as well. So this can be inherent risk, control risk, detection risk. Now what is inherent risk? ऐसी रिस्क जो ऑडिट में ऑलरेडी इन्वॉल्व होती है वो इनहेरेंट रिस्क होती है, करेक्ट? Now, in this case, when we have interested directors, inherent risk क्या होगी? It can be the complexity of the transactions, like complexity of the related party involvement. Sometimes the related party or the directors are not directly involved, but are involved by a different company, or we can say the shell companies. So these are inherent risk. Sometimes, we have certain directors involved, we have controls in place, but it failed to detect those risks. So these are known as control risk. Okay, even after having controls, those failed, we perform audit, and even the audit is unable to catch those, that risk is known as detection risk. Okay, so we understood three types of risk: inherent risk, control risk, and detection risk. Now, in case of interested director, what can be the inherent risk? Definitely conflict of interest. Control risk, control can be oversight. If you are a director, you can oversight everything. You are managing the companies. So it is a compromised oversight, or we can say in another language, in our audit language is management oversight of control. Correct? And the third risk is definitely the fraud risk. That means it is not, we can say it is an intentional act of doing something wrong. It's not an error. That can be misrepresentation, or there can be undisclosed relation. For example, a transaction has been passed in the board meeting and where the other director is interested. However, he does not show his interest over there. So it is known as undisclosed relation risk. Okay. Now it comes our responsibilities. We have responsibilities towards the audit. As management has responsibilities towards the audit and financial statement, we do have responsibilities. Why and what? So in order to be financial statements be present in the true and fair view, the first thing we should check is the compliance and the disclosure requirement of section 184 and 188. We discussed earlier that the transaction should be approved in the board meeting, so definitely we should verify the board resolutions and minutes. Third, the compliance should be with Ind AS and as per the applicability of the company. Fourth, every listed company is required to have an audit committee. So if you identify any transaction which you think is not appropriately passed in the board meeting, then it should be communicated to the audit committee. And then if you think the transaction is very large, that it may impact the opinion of the auditor, or it may impact the users of the financial statement, we can either qualify the report as well. So, we have different types of report: unmodified and modified. And modified will have qualified, disclaimer, and adverse of opinion. So it depends on the type of transaction and complexity of the transaction. We decide whether the transaction is qualified, disclaimer, or adverse. Okay. These are the responsibilities, but when you audit, you know about everything about the financials. So you have certain red flags also. You can look at certain things and understand why this transaction of related party can be a red flag. Okay. If you find certain transaction during your scrutiny, what scrutiny? Journal ledger scrutiny. Are there any undisclosed transaction? Or you can find certain keywords in the journal ledger scrutiny, bribe, directors, something like that. Then the transaction is a red flag to watch. Second, if you think the salary or remuneration are excessive. For example, the company is earning a profit of 2 CR, out of which we are paying 50 lakhs as a remuneration to one of the directors. That means that's a red flag. Third, transactions are not at the normal course of business. That means not at the arm's length price. Then definitely it's a red flag. And then the directors are saying we have taken the approvals in the board, and even they have the board minutes, but the transactions are not reflecting in MGT 7. What is MGT 7? It's an form which is filed with the registrar of companies which have the summary of board minutes. And if you see that board meeting is not shown to the MGT 7, and then you have the proofs of the board meeting, that means there is something fishy over there. So these are the red flags to watch. So in conclusion, what we can say is, what we have read, importance, किसका importance होना चाहिए? Documentation and disclosures का. Professional skepticism तो हमेशा होना चाहिए, and audit risk हमेशा रहती है. So we have to manage those audit risk in fair reporting. So if you have any further question, this is just a small presentation where we just get an overview of the audit for the directors or the related party transactions during a statutory audit process. Do contact me. I have provided my email ID for you, and then definitely we can discuss this. Thanks, everyone.